This week, Mark Carney, Governor of the Bank of England, admitted it was taking time to change the culture at the central bank. And boy, there's been a lot of change there already in the 20 months he's been in charge. We've seen a big change to the mission of the central bank. The Bank of England used to be split into monetary policy and then regulation, but the Governor wants to merge the two to get thinking across all areas. We've also seen big changes in the transparency of the Bank of England. Many more things are being published, and in particular, the minutes of the Monetary Policy Committee meetings, interest rate decisions, will come out at the same time as the decisions themselves, so we can know why people have voted in the way they have. And there's also improvements to accountability. The court, the governing body of the Bank of England, its minutes are also going to be published, and it also now has an independent evaluation office which reports to the court and can investigate whether the bank has been successful in the policy functions it's undertaken in recent years. But there's still big tensions at the central bank. Here are three of them. The first is the power of the governor himself. There used to be 2 deputy governors at the bank, and now there are 4, which you might think weakens the power of the governor, but in lots of ways it strengthens it because there aren't other big beasts within the bank who can really challenge the governor. And it matters particularly in a crisis where the Treasury, the Chancellor, who holds the money of the people of Britain, might have to bail out banks and might want to get opinions other than that of the governor. But the governor is still central to the Bank of England, and there is really some tension about whether that power is still too concentrated in one person's hands. Secondly, there's some tensions between committees. Both the Monetary Policy Committee and the Financial Policy Committee both operate in various different ways which have effects on the economy in quite similar ways. So the Monetary Policy Committee setting interest rates can affect the economy, but can also affect banks and regulations and the amount of borrowing and credit in the economy. Similarly, if the Financial Policy Committee restricts mortgages or does something to credit supply, then that also could affect credit, but also the economy. And if you're on one committee but not on the other, you might find that you're blamed for something but have had no power to do anything about it. So there's a real tension between some of the committees, and some of the way the bank has been working to try and offset that tension hasn't really worked. And thirdly, one area the bank wanted to modernise was to get rid of some of the sort of nods and winks, the governor's eyebrows suggesting what the bank policy was, and so it's made things again much more transparent, but maybe going too far so that all conversations with market participants now have to be written down and accounted for to create a paper trail. But that might just mean that in the end the bank doesn't have sufficient intelligence of what's really going on in markets, and there isn't really a safe space for people to come and talk to the bank about what's going on and concerns they might have. So there are some big tensions in the bank, but also some big changes over the past few years, and I think these changes are just the start of more changes to come.